Are there home loans for lower income buyers? Should I pay off my student loans before applying? Would you be able to do a video on persons who are travel nurses? Are you still considered a first-time home buyer even if your husband already bought a property? Can we apply for different down payment assistance programs on our own? He has the better credit and bigger savings. Would this make him the co-signer? Do school grants count towards income? Hey honeybees, welcome back to my channel, or if you're new, my name is Ciara and I do videos on finance and lifestyle. I'm a full-time mortgage loan officer and YouTuber, and I've helped hundreds of people to buy homes and build wealth. So I take everything I know and I share it with you in hopes that you will build wealth also. So today's video is gonna be a mortgage video. It's gonna be a Q&A. I do these from time to time because I often get lots of questions, and these questions are often very similar. So I like to do these Q&As so that I can answer lots of people's questions. Also, as a full-time mortgage loan officer, I work with clients only in certain states, and I have to devote my time mostly to my clients. So I can't really consult with everyone that sends me a question individually. I'm only one person. I just don't have the capacity to answer everyone's questions all the time if they're not a client of mine. So that's why I really love doing these videos. Definitely make sure, if you're not already, you subscribe and you hit the bell button for notifications. If you are a future home buyer or you have questions, make sure you leave them below. Also check out my home buying playlist and my loan officer playlist. A lot of the questions that I get have already been answered in my videos. So if I'm not answering your question, more than likely it's already been answered in another video. All right, let's get into it. So I'm gonna start with the YouTube questions that I picked, and then I'll go on to others. Crystal M says, you may or may not have answered this question, but if you're a first-time buyer, married, and you have multiple bank accounts, which one would you send the lender when they request the bank statement information? My hubby and myself have a joint account and separate savings accounts. Thanks for any advice. Okay, the bank statement or bank account you want to submit to the lender is the one that you are going to use for the home buying transaction. Whatever account that you have the money in that you're going to use for the house, essentially that's the account that you want to use. Let's say you have a ton of large deposits in an account. I would not use that. I would use whichever account has the most money in it, the money that you want to use to buy your house, and little to no large deposits. Large cash deposits, I should say. If you don't know what a large cash deposit is, definitely check out my home buying playlist because I've gone over this in detail in a number of videos, and I think it'll be really helpful. So the simple answer is to use the account that has the money in it that you want to use for your house, or use the account that has the most money in it. Also keep in mind you can use multiple accounts. It's just easier to use one account. A home buyer hack you can try, and something that I did when I was buying my house, is I created a savings account and a checking account specifically for my home purchase. And this account, you don't have to do two, you could just do one. So initially what I did was just one savings account, and that was the money that I keep my money in for the house. I don't have a lot of transactions coming in and out. If you're getting a large sum of money that you want to deposit and you don't want to have to worry about documenting it, put the money in there 2 to 3 months before you want to apply, and then that way you won't have to source the money because the money's already been in there and seasoned for, 2 bank statements, and there's no, transactions. Ideally, that's the easiest thing. The simplest hack, open up an account specifically for your home buying and put the money in there as early as possible. Avoid large deposits and you will be good to go. Thank me later. D Gaines says, hi Ciara, you mentioned something about student transcripts to prove you were a student. Do school grants count towards income? Not loans, they were Pell Grants. Grants do not count towards income because it's not money that you're making from a job. So essentially when you're thinking of income in the home buying process, it's money that you're making from a job or child support or disability. It's regular occurring income that's been consistent for at least 2 years, you're set to continue to receive it for 3 more years. Something like a grant would not be considered income. It can, however, be considered as reserves or money that you have in your account. And the more money you have in your account, the better that looks to lenders. You can definitely use it as a savings, as reserves, but it is not counted as income. Okay. Hi, Ciara. First off, thank you for this. So informative and helpful. You're welcome. Would you be able to do a video on persons who are travel nurses who work 13-week contracts but have high income, looking to purchase a home in 2022, but it seems like there's roadblocks for travel nurses? So this is such a great question, as I get this question a lot. If you are a travel nurse, yes, you can buy a home. I have worked with a number of travel nurses. Now, travel nurses who work on contracts, you do experience more challenges because of the inconsistency of your income. So here's what I would recommend if you are a travel nurse and you want to buy in 2022. Number 1, make sure that you are able to get a letter from your job stating the nature of your job as a travel nurse. One thing that underwriting will want is not only a WVOE, which we call a written verification of employment, but they'll also want your job to confirm the nature of your job traveling as a nurse. 2, try not to have job gaps of 3 months or more. Essentially, when you're buying a home in general, you don't want to have any job gaps. If you're a contract worker, underwriters understand that, and they're a little more lenient. But if you've gone over 3 months without another contract, it looks bad. It looks inconsistent. So make sure that you are working consistently and having, a gap in jobs or contracts no more than 3 months. I would also say, if you are a travel nurse and there is any way you can have your job to pay you on a salary basis, that's going to be the easiest. Otherwise, we're going to be looking at your W-2 income and what your income is year to date, because that is the best way to gauge your income. So just keep that in mind, and the best advice I can give you is to keep your income and your jobs as consistent as possible. When you are buying a home, someone's giving you hundreds of thousands of dollars. What they're really looking for is consistency. They want to be able to trust that you're going to be able to pay for the house and long term. So the more you can build consistency, the better. Okay, Crayola Life says, hi, thank you for your video. Am I still considered a first-time home buyer even if my husband already bought a property back then? His income for the past 2 years has been in the same line of work, but different companies. Can I add him on the loan since he has more income than I did? We are planning to move to Texas ASAP. Please help. Your first question, are you still considered a first-time home buyer even if your husband already bought a property? Most lenders are going to gauge if you're a first-time home buyer by if you have any history of buying a home on your credit. If your husband bought a property and you were not on the mortgage and it did not go on your credit, then you would be considered a first-time home buyer. If your husband bought a house and you were on the mortgage, say as a co-borrower, then you would not be considered a first-time home buyer. If your husband bought a property and you were a non-borrowing spouse, meaning that your debts were counted into the DTI. So if you live in a community property state and a spouse wants to buy a house, usually you have to count the other spouse's debts, even if you aren't able to count their income, even if we don't use their credit score. You still have to put their debts in there. When you do this, it's called a non-borrowing spouse. Because while we're considering your debts, you were not on the loan, you were not on the mortgage. If that was the case and you were a non-borrowing spouse, then yes, you would still be considered a first-time home buyer. So to make it super simple, if it went on your credit, no, you're not a first-time home buyer. If it didn't go on your credit, yes, you're a first-time home buyer. Your second question, can I add him on the loan since he has more income than me? Yes. you can have him be a co-borrower. Co-borrowers have to qualify the same way a borrower does. So you're gonna wanna make sure that while his income is good, you also wanna make sure that his debts aren't overpowering that. You did say he bought a property, so will that property still be on his credit, taking up space in the DTI? Or are you guys selling that property? That would be some of the questions I have, but yes, you can add him onto the loan. So if you are considered a first-time home buyer, but you want to add your husband on because he makes more income, you can totally do that, and your purchase will still be as a first-time home buyer, even though he has owned a property. And hi, pretty. Kaya LaRue says, hi Ciara, this video was very informative. Question, I do cash envelopes and deposit the money once it hits a certain amount. Should I stop doing that if I want to buy a house? I do have my budget sheet of every cash envelope if that would help. Only stop doing it if you're depositing large amounts at a time. If you're depositing a few hundred here and there, it's fine. But if you're depositing large amounts, like if you start hitting 1,000, 1,500, 2,000, 2,500, 3,000 in cash, I would stop doing that altogether. If you can minimize the cash deposits, that's gonna be the best. Or the home buying hack that I recommend, to create a separate account just for your home purchase and keep a separate account for your cash envelope deposits. And that way you don't mix the two. And when you go to buy a home, you're not looking at all these jumbled deposits and cash and transactions. If you have an account that's strictly for your home purchase, that makes it so easy, so clean. You won't have a ton of transactions going back and forth, and that's what I would recommend. Either that or just keeping the cash deposits low. Now, one thing I do encourage you to do if you are looking for a method of cash accounting, credit building, monitoring your credit, preparing for a home, is to use the Credit Sesame app. It's a really helpful platform in helping you achieve your goals, whether that's buying a house or buying a car, building credit, getting better insurance and loan rates, getting a job, renting an apartment. I mean, it can just help you all around the board. One thing that I really love about Credit Sesame is that they have this program, and it's a Credit Sesame credit builder program. It actually helps you to build your credit by allowing you to take advantage of things like on-time rental payments, and you also get cash rewards for improving your score. The money that you already have and the debit purchases that you already make are now used to help you build credit. You're able to track your score every day, track your growth. You also get tips for growth, and you can even get cash rewards for improving your credit score. You know, I recommend it for anyone and everyone that really, you just want to monitor your financial health. Even if you're not necessarily buying a home, it's really, really helpful because you can get your credit score for free. You can get real-time credit monitoring alerts and theft protection, which is super, super important. You can also get a Sesame Cash prepaid debit account, and this is something that I might possibly recommend to those of you who are using cash accounting. Is really useful because you can keep your cash transactions separate from your main account that you're going to use to purchase your home, but also you can get cash rewards for building your credit score and improving your credit score. You can actually get $10 for every 10 points that you improve your credit score in the first 30 days. You also get free ATM withdrawals, early paydays, and you build your credit by making everyday purchases. Credit is probably one of the most important things in the home buying process, and not just your credit score, but also what's on your credit. So anything you can do to improve your score and build credit health is a win in my book. If you are looking for a way of accounting, I think the Sesame Cash debit account is a great way. You can also take advantage of the Sesame Cash credit builder program, which I think is awesome, and utilize all the tools they have on their platform. I will link it in the description box below. It's a great program, a great platform. Click on that link so you can sign up for a free Credit Sesame account, and so that you can start using Sesame Cash. And thank you to Credit Sesame for sponsoring this video. This is from Ashley Costa. Hi Ciara, I've been watching many of your videos and appreciate the content. Thank you. I have an inquiry that's a little different than what you've mentioned in your Q&As. My boyfriend and I are not married, but looking to get a home together this year. How would it work with us getting an approval together but filing as single? Can we apply for different down payment assistance programs on our own? How does household income apply in this case? He has the better credit and bigger savings. Would this make him the co-signer? Thank you for the information you share. Looking forward to all the new page ideas. Thank you. You're not married, but you want to buy a home together. Okay. How would it work with us getting an approval together but filing as single? It would work the same way as a borrower and a co-borrower. You both would apply, you both would be on the loan, you both would be on the same application, you both would submit your individual documents. It really wouldn't change the process at all. Can we apply for different down payment assistance programs on our own? When it comes to down payment assistance, the way I work is I have a lender that has a down payment assistance program that would apply to your application, and it would be applied to your mortgage application, the both of you together. Now, if you were to get third-party down payment assistance, I'm not sure how that would work. It would depend on however that third party requires. It would depend on what they require, how they see it. But with the down payment assistance I offer to my clients, you wouldn't be applying. You would just do the home loan application, and then I would make sure you qualify for the down payment assistance. How does household income apply in this case? So the way the income would work is that we would look and calculate each of you guys' individual income the same way we count anyone's income that's applying. We calculate your income and they're separate, and then we add it together to get one large monthly income amount, and then that's the income that we use. He has the better credit and bigger savings. Would this make him the co-signer? No, it wouldn't. You guys would choose who you want to be the borrower and who you want to be the co-borrower. That would be up to the both of you. Essentially, you're seen as one application together. So that means when it comes to credit scores, we're going to use whichever one of you has the lowest qualifying score. We're going to go by that. That's going to be your qualifying score as a whole. If he has lower credit, regardless of if he was a borrower or a co-borrower, it's still counted the same. Your savings, that also wouldn't determine who's the borrower and the co-borrower. You guys could use the same bank account and we could use that. If you have separate bank accounts, we'll use both of you guys' bank accounts. Essentially look at it as it's both of you together on one application. So it's two people, but essentially it's one application. So a lot of things like income or additive, savings, we're gonna look at how much, if you do two separate savings accounts, we'll look at how much you both have, add it together to see how much you have together for your application. That's kind of how it's looked at. But when it comes to borrower and co-borrower, you guys can decide who you want to be the co-borrower and who you want to be the borrower. That was all for Ashley's questions. I hope that answered your questions, Ashley. Now let's get to Instagram. Okay, so I did get a lot of, one thing I'll say is on Instagram, for whatever reason, I did ask you guys to send me mortgage questions, and I got a lot of loan officer questions. This is strictly for mortgages. I will do a separate video where I answer loan officer questions, but this is strictly for mortgages. So if you sent me a question and it was loan officer related, whenever I'm ready to do a loan officer Q&A and I post the prompt for that, please send me your loan officer questions at that time. But this is just for mortgages. Oh, this is a good question. VA versus FHA versus conventional loans, pros and cons. The VA loan is strictly for veterans and it's zero down. So I would say the con for VA is that if you're not a veteran, you can't get it. The pro is that it's no money down. When it comes to FHA versus conventional, FHA allows more people to qualify that have lower incomes and higher debts because the DTI threshold is the highest of all the loan types. So essentially FHA is the easiest to qualify for. It allows you to get approved for the most usually, and there is a little bit more restrictions on the properties, the kind of properties you can buy. Pro for FHA is that it's a lot easier to qualify. You can get more house. The cons are that FHA is a little stricter on the kinds of properties and the condition of the properties. Also, with FHA loans, you have a monthly mortgage insurance fee that goes into your monthly mortgage, and it stays on your mortgage for the life of the loan. Whereas conventional, that monthly mortgage falls off once 20% of the loan has been paid off. So a lot of times when you see people putting 20% down, it's because they have a conventional loan and they want to avoid that PMI, private mortgage insurance fee, and it just helps bring your monthly payment lower. The con with conventional, though, is that it's designed for higher income, higher credit scores. So if you are someone who doesn't have maybe a high income, or let's say you have more debt, conventional may not be the best option for you. Also with conventional, the DTI threshold is a good bit lower than FHA. So if your income isn't heavily outweighing your debt, then it may mean a lower approval amount. Also with conventional, their rates tend to be higher than FHA. I would say on average about 1 to 1.5%, which isn't, the end of the world or huge, but the rates tend to be a little bit higher with conventional versus FHA. So that's why it's really important to have a good loan officer who can look at all these different things for you to determine and to help you to determine what is going to be the best plan of action for you, what the best loan type is going to be for you, and all of that. So yeah. How long after purchasing a vehicle should you wait to start searching? I'm assuming you mean how long after purchasing a vehicle should you wait to start searching for a home? I always recommend being pre-approved first, because what you don't want to happen is that you look for a home, you fall in love with the house, you go to get pre-approved, and you're not approved for that, and it can just be a downer. So I would say after purchasing a vehicle, or no matter what the situation is, you should get approved first before you start looking for a house. How helpful is it having compensatory factors for mortgage approval? When she's talking about compensatory factors, she's talking about compensating factors. Compensating factors are elements of an application that make your application stronger. Compensating factors include residual income, which is income outside of the income that is counted on your application. Let's say you have any other income coming from a rental property, or you have someone that lives in your home that gives you documentable funds, or let's say that you're getting other income from kind of a non-traditional source, or that you have some form of residual income. You have other income that's coming in outside of just what you get from your job. That's considered a compensating factor. Also, money that you have saved in the bank, this is one of those compensating factors. That's what we call reserves. And again, reserves are just money that you have saved above and beyond what is required for the purchase of your home. It has to be your own funds. When you have typically about 3 months of reserves, and why I say in months is because that's how underwriting will look at it. They're going to quantify the amount of money you have saved as reserves. So let's say your estimated monthly mortgage payment is going to be $1,000. $3,000 would be considered 3 months reserves. $2,000 would be considered 2 months reserves. So let's say you have all the money for your down payment and closing costs, whatever you're required to buy your house, and then you have an extra $3,000 saved in a savings account or in a retirement account or in an investment account. That is considered reserves, and that is considered a compensating factor or strengthener for your application. So yes, compensating factors are extremely helpful when you are going to get approved for a house. The more compensating factors you have, the better. Ooh, this is a good question. Okay, should I pay off my student loans before applying? Okay, should you pay off your student loans? Ask your lender because this is going to be different for everyone, right? Like, some people may need to get on a standardized payment plan. Some people may be fine the way their student loans are. Some people may need to get on a 0 a month income driven repayment plan. Some people may need to pay them off. Everyone's application is so specific to their situation. Your DTI is specific to you, right? Because it's specific to your income and your specific debts. So if you have a DTI that is making it too high for you to get approved, then yeah, paying off your student loans may help. Or it may not be your student loans that you need to pay off. There may be some credit cards you need to pay off, or there may be a collection that needs to be paid off. It's very specific to each individual, and that's why I say ask your lender before paying off things, because they'll be able to help you decide what needs to be paid off, if at all, how much, and when. Are there home loans for lower income buyers? I would say the FHA loan is probably what you consider for lower income. You don't have to necessarily have a lower income to get FHA, but the FHA loan is what allows most people to still get approved that have lower incomes. I guess the answer to that would be yes, FHA, but FHA is not a loan that is specific for low income buyers, but it is ideal. It is the most ideal loan for lower income buyers. Another good question, how do you know when you have enough money to start looking for a mortgage? This is why I say go to your lender. You'll know when you go to your lender and they do a pre-qualification on you. They'll let you know if you have enough money yet, or if you're ready yet to start applying for a mortgage. Also, if you're just wanting to get an idea of like how much money you need, think of what price point of house you want. So for easy math, let's say you want a $100,000 house. In order to figure out how much money you'll need to buy that house, consider what loan type you're likely gonna have. I would say default to the minimum down payment percentage that's FHA. Let's say you're buying a house and it's $100,000. Let's say it's $100,000. You'll want to save 3.5% of whatever the purchase price of the home you want is. You'll need to save that for a down payment. So for example, if you're going FHA, you're buying a home that's $100,000, you'll want to save $3,500 for your down payment. That's how much your down payment's going to be. When it comes to closing costs, these are more specific to your property and the title company you choose and what your escrows or your taxes and your homeowner's insurance come out to be. So it's kind of hard to give you a finite number, but I'll say most people estimate around 2 to 3% for closing costs. If you are buying a $100,000 house, let's say you go by the 3% for closing costs, your closing costs would be $3,000. So in that case, you would save $3,500 for your down payment plus $3,000 for your closing costs. So total, you would save $6,500. That is a very simple, quick, and easy way to get an idea of how much money you would need. And so then, once you've saved $6,500, that's when you're about ready to apply and start buying. That was just an example, but I hope it gives you an idea. So, I made it through all the IG questions. If you guys have more mortgage questions that I have not already covered in a previous Q&A or in my videos, definitely make sure to put them in the comment section below. Also, make sure you're following me on both my Instagram accounts. I have a loan officer account and a general account, just like a fun lifestyle account. My loan officer Instagram is Ciara Foster Loan Officer, and my main account is Ciara Elaine Media. Whenever I do Q&As, I'm always gonna put a prompt on IG, so definitely make sure you're following me so that if you have a question, when I do my next Q&A, you can get it answered. Also, definitely check out my previous Q&As. I can't tell you guys how many times I get questions that I have covered multiple times and covered in detail in previous videos. Check out my home buying playlist because I have a chock full of information in there. I've done multiple other Q&As, so your question, more than likely somebody else has had something similar. So definitely check that out. Make sure you're subscribed so you can be a part of the Honeybee fam. Click the bell button for notifications so you can know when I upload. I respond to all comments and questions in the first 24 hours of uploading a video, so you'll want to make sure you have that bell button clicked. Thank you guys so much for watching. I love you to the bank and back, and I will see you in my next video.